Let us begin with a clear definition. The income statement, also called the profit and loss statement or the statement of earnings, is a fundamental financial report that summarizes a company's financial performance over a specific period, such as a quarter or a year. Unlike the balance sheet, which shows what a company owns and owes at a single moment, the income statement measures the flow of revenues, expenses, gains, and losses across time. Its central purpose is to answer a simple but critical question. Did the company generate a profit or a loss during that period? For students of corporate finance and investment, understanding the income statement is essential because it reveals the underlying profitability of a firm, which drives its ability to pay dividends, reinvest in growth, service debt, and create shareholder wealth. In this lesson, we will explore the structure of the income statement, its key components, the principles governing its preparation, and how to interpret its numbers, using descriptive examples to make each concept concrete. The scope of the income statement is broad. It serves as the primary source of information for evaluating operating efficiency. Investors look at it to assess whether management is generating sufficient revenue and controlling costs. Creditors use it to determine if a company's earnings can cover interest payments. Financial analysts rely on it to calculate valuation ratios, such as the price-to-earnings ratio, and to project future cash flows. Without a clear grasp of the income statement, any analysis of a company's financial health remains incomplete. The statement follows a logical step-by-step format that starts with revenue and subtracts various layers of expenses to arrive at net income, often called the bottom line. Each step reveals a different aspect of profitability, and we will walk through them in order. The first line of the income statement is revenue, also known as sales or turnover. Revenue represents the total amount a company earns from selling its goods or services to customers before any costs are deducted. Under the accrual accounting principle, revenue is recorded when it is earned, not necessarily when cash is received. This is called the revenue recognition principle. For example, if a furniture manufacturer sells a sofa on credit in December but receives payment in January, the revenue is recorded in December, because that is when the sale occurred and the earnings process was complete. Revenue is often presented net of returns, allowances, and discounts. A descriptive example: a retail chain sells clothing worth $10 million during a quarter. Customers return items worth $500,000, and the chain offers early payment discounts of $100,000. The net revenue reported would be $9,400,000. Revenue is the starting point because all subsequent calculations depend on it. From revenue, the income statement subtracts the cost of goods sold, often abbreviated as COGS. This represents the direct costs attributable to producing the goods or services that were sold. For a manufacturer, cost of goods sold includes raw materials, direct labor, and factory overhead directly tied to production. For a retailer, it includes the purchase price of the merchandise that was sold. Importantly, cost of goods sold does not include selling, general, or administrative expenses, which are accounted for separately. The result of subtracting cost of goods sold from revenue is called gross profit or gross margin. Gross profit shows how efficiently a company produces its products. A high gross profit relative to revenue indicates strong pricing power or low production costs. For instance, a luxury watchmaker might sell a watch for $5,000, with cost of goods sold of $1,000, yielding a gross profit of $4,000. A discount watch seller might sell a watch for $50 with cost of goods sold of $30, yielding a gross profit of only $20. The gross profit margin, which is gross profit divided by revenue, allows meaningful comparison across companies and industries. After gross profit, the income statement subtracts operating expenses. These are the costs of running the business that are not directly tied to production. Operating expenses typically include selling expenses, such as advertising, sales commissions, and shipping. General and administrative expenses, such as salaries of office staff, rent for headquarters, and legal fees. And research and development expenses, which are especially significant in technology and pharmaceutical companies. Depreciation and amortization are also included as operating expenses, even though they are non-cash charges. Depreciation allocates the cost of a long-term asset, like a machine or a building, over its useful life. For example, a delivery company buys a truck for $100,000, expects it to last 5 years, and records depreciation expense of $20,000 each year. This expense reduces reported profit even though no cash leaves the company that year. The result after subtracting operating expenses from gross profit is called operating income, or earnings before interest and taxes, commonly abbreviated as EBIT. Operating income measures the profit generated from the company's core business activities, excluding the effects of financing and taxes. This is a key figure for financial managers because it reflects operating performance independent of how the company is funded. From operating income, the income statement next accounts for non-operating items. These include interest income from investments, interest expense on debt, and gains or losses from the sale of assets or from foreign exchange movements. For most companies, interest expense is the most significant non-operating item, representing the cost of borrowing money. Subtracting interest expense and adding any non-operating income gives earnings before taxes, also called pre-tax income. Then the company subtracts income tax expense, which is the amount of taxes owed to government authorities based on pre-tax income. The final line after all deductions is net income, also called net profit or the bottom line. Net income represents the amount of profit that belongs to the shareholders after all expenses, including taxes, have been paid. If net income is positive, the company has generated a profit. If negative, it has incurred a net loss. A complete descriptive example will help pull these layers together. Consider a bakery company for a full year. The company reports revenue of $1 million from selling bread and pastries. The cost of goods sold, including flour, sugar, eggs, and direct bakery labor, is $400,000. Thus, gross profit is $600,000. The company then incurs operating expenses. Selling expenses of $100,000 for advertising and delivery, general and administrative expenses of $150,000 for rent, office staff, and utilities, and depreciation expense of $50,000 on its ovens and delivery vans. Total operating expenses are $300,000. Operating income, or EBIT, is therefore $300,000. The company has interest expense on a bank loan of $30,000 and no other non-operating items. Earnings before taxes are $270,000. Assuming a corporate tax rate of 20%, the income tax expense is $54,000. Net income is $216,000. This net income can either be distributed to shareholders as dividends or retained in the business for reinvestment. Several important principles govern the preparation and interpretation of the income statement. The matching principle requires that expenses be recorded in the same period as the revenues they helped generate. For example, the cost of goods sold is matched against the revenue from those same goods. Advertising costs that generate sales in the current period are expensed now, not later. The revenue recognition principle, as noted, determines when revenue is recorded. Another principle is materiality. Small amounts that would not affect a decision-maker's judgment may be aggregated or treated simply. Consistency is also vital. A company should use the same accounting methods from period to period so that comparisons are meaningful. If a company changes its inventory valuation method, it must disclose that change and explain its effect on the income statement. Understanding the income statement also requires awareness of its limitations. Net income is an accounting measure, not a measure of cash flow. Non-cash expenses like depreciation reduce net income but do not reduce cash. Conversely, capital expenditures are not expensed. They are capitalized and then depreciated. Therefore, a profitable company can still run out of cash. The income statement is also subject to management's estimates and judgments, such as the useful life of an asset for depreciation or the amount of bad debts expected from credit sales. Different choices can produce different net income numbers. Moreover, the income statement excludes certain items that may be important for investors, such as the value of internally generated intangible assets like brand reputation. Despite these limitations, the income statement remains one of the most widely used and informative financial reports. In summary, the income statement is a periodic report that measures a company's financial performance by showing revenues, expenses, and net income. Its structure flows from revenue down to gross profit, then to operating income, then to earnings before taxes, and finally to net income. Each subtotal provides useful information about different aspects of profitability. Descriptive examples, such as the bakery company, demonstrate how the components fit together. Mastering the income statement is a foundational skill in corporate finance and investment, allowing you to evaluate past performance, project future earnings, and make informed decisions. Remember to use it alongside the balance sheet and the statement of cash flows for a complete picture. But the income statement remains the starting point for any analysis of profitability.